Are you ready now? Because the presentations, there's like a black square on the screen.
Yeah, we noticed that we have that issues. I think, wait, can you wait for a minute? I'm sorry.
Yes, just tell us when you're ready.
Coba dulu aja, Mas.
Shiva, your mic is muted.
Yes, Mr. Ching, we're still waiting.
First of all, we would like to apologize for the technical issues, but good afternoon, everyone. We shall begin our presentation. Good afternoon, everyone. Imagine starting a business with big dreams, only to face a reality far different from what you have planned, with lower demand, tighter competition, and the challenges just to stay afloat. That's exactly where our journey began with the MBS e-case competition. We are MBS, and today we'll share how we navigated these challenges, transforming setbacks into growth and building a strategy to maximize value and sustain long-term success. Next, please. When we started this competition, we knew success wasn't just about short-term wins in each round. It was about creating a business that could stand the test of time. Our goals were clear, and it is very clearly defined in our MBS framework, which is to maximize our NPV, enhance customer fulfillment, boost annual revenue, improving interest payment capacity, utilize capital efficiently, and sustain long-term performance. And every decision we made were aimed at hitting the 6 targets consistently across the game. Next, please. To achieve those goals, we built our strategy on 3 main pillars. The first of all being a healthy and profitable business. We optimize pricing, finance, and production to stay profitable while maintaining strong KPI like net present value and return on capital employed, or ROCE. Secondly, we project sustainable expansion by planning our growth in line with market conditions. So we target consistent revenue growth and a high supply chain order fill rate. And third, we maintain prudent financials by projecting gradual expansions. We kept our financial management prudent to maintain a controlled debt composition and to allocate our capital strategically. Next, please. And we split our strategy into 3 key phases. The first one is the initial startup phase, which is all about setting the foundation for the future runs. In this phase, we secure capacity for future growth and create early demand. Here, we kept marketing expenses low, invested heavily in raw materials, and maintained a stable R&D. Then came the burning up phase, which is where we aggressively push for market share. This was where we ramped up marketing expenses, kept R&D stable, and introduced moderate price adjustment to attract consumers faster. And finally, the sustaining phase. where the focus shifted from aggressive expansion into staying competitive in the mature market. We adjusted marketing to a more moderate rate, while at the same time we also expanded our R&D and continued fine-tuning our prices to maintain relevance in the market. This step-by-step approach has let us adapt to market shifts without losing sight of our long-term vision. And the next part of the presentation will be explained by Giovanni.
Okay, we have the issues from the round, right? The first is, in the first round, we faced a challenge as a potential demand turned out to be much lower than we had expectation. The gap between our expectation and the actual market condition describe our growth capacity and result in the significant net loss. However, in the following round, the situation is improved. With a higher fill rate, our revenue growth became more stable. The next slide, please. In our strategy, the way we increase the potential demand strategy from marketing and R&D. R&D was kept moderate to maintain stability. In the first round, we made a mistake by setting the marketing expense too low, which limited our early growth. In the following round, we significantly increased marketing, which boosts product image and quality. The result, our potential demand keep growing, and the end, we manage our two full marketing. The next, I'll present with Meta.
Aligned with our main goals, that is boosting revenue and meeting demand, we must ensure finished goods are available in just the right quantity. We start by estimating demand through key business levers. Our concern is the fulfillment of the potential demand. As we expected, that the potential demand is continuously growing, and then we need to expand and maximize our capacity through equipment investment and labor. Considering Model 2 settings, there is one shift with 1.5 overtime. In approving a production request, we must ensure it aligns with our production capacity and projected demand, that raw material are sufficient, and that we consider our finished goods stock as the maximum available for sale.
Okay, for our purchasing or material purchasing decisions, we're guided by production planning, inventory levels, price stands, and budget constraints. In round 2 and 3, no purchases were made as we relied on existing inventory to meet consumption needs. Optimizing capital allocation. Strategic purchases in 1, 4, and 5 ensure sufficient stock to sustain production while taking advantage of favorable unit price. This approach balanced cost efficiency with operational continuity. For the performance from the decision we made, we can observe an increase in revenue, product image, and product quality, built in a slow and relatively insignificant manner from round 1 until round 5. For the conclusions, we have miscalculation in round 1, set product image and quality too low. So the impact is we have reduced customer perception and loss of initial market share. For the recovery, adjust strategy in later rounds to improve product image, enhance quality, and regain market share.
Okay, I'm sorry, MBS team, your time is up. Now we move to the next session, the Q&A.
Thank you.
Okay, I guess I want to start the first question. Throughout the game, do you have set your management objective for some important parameters, like what will be your objective for your finished good inventory, how much you need to maintain, and what about the raw material inventory? Do you have a saved level? So have you put that into consideration when you follow the game?
Okay, thank you, Mr. Cheng, for the question. And as for our management objective, specifically for the finished goods, we actually have set some objectives in somewhere around below the 100,000 level for the finished goods. But we did not expect that the initial round would have a much lower potential demand than what we projected. And therefore, we switched our strategy into investing more in our finished goods and instead invested less in our equipment investments.
I want to make a comment because in my criteria, I give you the configuration of the structure. Specifically, I ask for management objectives, and in your presentation, you never show one slide that tells anything about your management objectives. Why did you not prepare that slide?
Our management objective is actually, and we did not actually have a specific number for the objective in itself, but instead we rather have a range as per what we want to achieve, although we did not have enough time to put that in our presentation, sir.
I leave it to the other judges. Any question?
Okay. Maybe let me ask one quick question. When I see your presentation, I see the way that you forecast the amount of the quantity of the potential demand from the marketing, R&D, and the seasonal indicator, if my memory serves me right. But I didn't see anything you mentioned about your observation from the market. That is the sales price, selling price, the sales, maybe not the revenue, but the sales, marketing image or product image from your competitors. So I just want to know, have you put this in mind while you are constructing your business strategy in your decision?
I'm sorry, sir. Can you repeat a bit the question about what have we put in mind?
Yeah. Have you put this in mind to evaluate the strategy given by your competitors before you make your decision in each round? Yeah. Because I did not see you mention this part in your presentation.
Okay, as per our competitors, we actually have expected that our competitors will put up higher marketing expenses and how they will set the price, and we adjust accordingly to that. But in terms of have we actually put that in mind? Yes, we have actually put that in mind. But since we do not yet know how they will act in this final round, so most of those adjustments are made in the round 2 and 4th. But in the first round, we put into consideration our main strategy is that we didn't want to be the market leader in the first round. And our focus was we try to gain the market share from our competitors starting in round 2 and above. But for the first round in itself, we didn't put much consideration except for how much the general sales of our competitors will be. So therefore, we intentionally put a pretty lower number of marketing expenses. But after that, we we try to adjust based on how much our competitors are putting in their marketing and R&D efforts. And therefore, we try to match that and try to compete with that afterwards.
Okay, thank you. Okay, I'll leave it to the rest of the panel. Yeah, thank you.
Okay, so what made you decide like to buy quite huge volume of raw materials at the beginning at the round one? And then what should you consider like when you buy the raw materials? Thank you.
Thank you for the questions. Actually, the decision we made before we bought the raw materials is we want to make a stock of raw materials. So the stock is enough to make to fulfill our production capacity, and we want to stock it not just for next round, but we want to make sure that the raw material we have is enough for maybe the next 2 or 3 round, because one thing that we noticed that every round the unit prices for the raw material inventory is always increases. So we want to make sure even though we bought a raw material inventory, we have still enough cash balance.
Okay, thank you.
Okay, thank you, Team MBS. Now the timer has ended. Thank you so much for the commentary for the team. So now you may go back to the main room.
Thank you so much for the
Charismatic Technology 10 November. My name is Risma Pribadi and you can call me Risma. And alongside my teammate is Kezia Natania Zahira and you can call her Kezia. We are here to present our strategy and financial performance analysis for the MBS e-competition final stage 2025. Throughout this presentation, we will guide you through our strategic decision, supported by financial data insight, demonstrating how we aim to maximize sustainable profit while maintaining a strong premium market position. Beside that, thank you for this opportunity and we look forward to sharing our journey and our forecast for the future with you. Next. Okay, thank you. And on this slide, I will explain the main goals that guide our team throughout this competition and how we implemented our strategy to achieve them. First, our goals were to maximize sustainable profit, which means focusing on earning consistent and lasting profit by carefully balancing revenue growth with cost management. To secure and maintain our market share, although market share is not directly affiliated in this competition, it plays a role in influencing our sales. Therefore, keeping a stable market share was important for our overall success. To meet these goals, we applied a strategic plan focusing on several key elements. We commit to continuous improvement in product quality through ongoing investment in research and development. This allows us to uphold our premium pricing strategy with confidence. Okay, and to achieving these goals, To achieving these goals, our strategy implementation focus on the following key element. And this is our strategy implementation for profit growth. Is premium pricing reflect high product quality. The second point is cost efficiency without lowering standard. The third point is production planning based on demand trend. Then market share stability. The first one is continuous improvement in product quality. The second point is strong and consistent brand image. And the last one is build loyal customer based through engagement.
Next slide. So in this slide, we provide an overview of our performance across all 5 rounds. Here, including first of all, net profit. We start with a net profit of 306,310 in round 0. But we have a significant loss of over $562,000. But we managed to turn this around by round 3, achieving a positive profit of $306,510 US. This was a crucial turning point, but unfortunately, we faced another major setback in round 4 with a loss of over $607,000 before we recovering slightly to $37,000. Also, on our market share, in round 0, we start in 10% of market share, but we saw a slight decrease to 9% in round 1 and round 3, and a sharp drop to 4% in round 4 before recovering to 7% in the final round. And our product image and quality, this is one of our most consistent success because this is our strategy to maintain the product image and quality quite high to improve our sales, because we analyzed from the preliminary competition that the product image and quality has a impact to sales. But because we invest more in the product image or the marketing, the product quality is quite average behind the other company. Next. From the comparison to round 0, in round 1, we made a first major strategic move. We drastically increased our marketing expense from $150,000 to here $10,000. And here our R&D, we put it in $480,000. But because we request productions is too high, more than the product requirement, so we kind of have a loss here. But in round 3, we decide to put the marketing expense invest more in the marketing expense, and the R&D is still quite same from the previous round, and we can make a profit into $306,000. Next.
Because we have a limit time, maybe next to conclusion. Okay. For the conclusion is, through our analysis of each round, we found that R&D and investment and marketing expense have the most significant influence on driving sales volume and sustaining product positioning in the premium segment. For our team, which consistently maintained
Sorry, charismatic
a high price point between 7 and
Sorry,
7.3,
but the
these
time
two
is up.
factors
We
were
have
critical to
finished the Q&A
ensuring
session.
that customer perceived strong product quality and brand value despite the competitive pressure. Okay, thank you for your time and attention. We are happy to answer any question you may have. Thank you from Charismatic.
I observed in the data that have shown the product image. There are 3 rounds that show, in fact, high level, but in spite of the high level of product image, in fact, the sales and profit are very poor, and even make losses. Can you explain why that happened?
Okay. Is it the loss in round 4? If I'm not wrong.
You can show the slide again. On the performance, we see product images, and you need to convince me that you know what is going on, right? So you have got the reason why you got high product image is because you put in a lot of marketing expenses, but at the end, your sales is poor, and you are, of course, then as a result, losing money. Why? If you are not able to answer, let's other questions. Otherwise, you are losing credit. Maybe let other judges ask questions.
Mrs. Lisa, maybe you have a question for the charismatic team?
Yes, actually, I have same issues here with Mr. Ching about product image, especially product image in round 5, because it decrease very jump a very high number. I forget the number, but very become only 2 the point for product image. I want to know why this is happen. What is the reason why it happened? Thank you.
First of all, we put an investment on our marketing that impact in product image, but in the round 3, we didn't put an investment on our product quality or R&D. That's why the product quality is not improving. It's lagging behind the other company. So with the price that we give to the client, it's not commensurate. That's why we have a major drastically loss, especially in the sales.
No other question?
Oh, but in round 5. Yeah. the product image in round 5. It's very decreased significantly, I think.
Sorry, the product image in round 5 has to 200, but here we put it in a wrong.
Yeah, I think it is a typo area. Error. It's not 2.
Yeah, it's a typo.
I think that's I can understand.
This
Yeah.
one is 1.8 and it's 2.
Right.
We actually in round 5, because we have a major loss in round 4, we need to maintain our profit to be high again. So we invest quite more in product image. Here we put a 500,000 for the marketing expense. Also, because we're lagging for the R&D expense, we put it again $420,000. But it's still not helping, because it's helping, but it's not give us a profit. But as we maintain to make it not to loss from the round 4.
I can give you some explanation, and that will help you learn. In fact, the round 4, your revenue sales is low, and that can only happen because you don't produce enough. You don't have products to sell, even though your product image is high, and therefore your potential demand may be also high due to that. But you're not producing enough, so your production planning is probably not well planned. Right. So and why your revenue, why you are not selling enough? Because you don't produce enough, and maybe also because you don't have the raw material and to support the production. So this is probably where you should be looking for the answer. So
yeah, thank you, Mr. for the explanation. For additional, we actually don't buy any raw material purchase in round 2. That's why we cannot produce more in round 3 or round 4. Okay, thank you, charismatic team. The Q&A for the judges' time is done. You may go back to the main room. Okay, the time started when you start speaking.
Okay. Hello, everyone. I am Winston Jonathan from the Group Hunter. Today we will be present about the business simulation. Okay. For the side of the key issues, market condition. We analyze the seasonal indicators and the competitors for the price. Then it will help us to decide whether to compete aggressively or whether to adopt a more conservative. For the second is resource availability. We consider our availability capital that ensure that our plans will be realistic and achievable. For the third is dividends. As long as we can share the dividend, we do it. For the next slide is the target. This table outlines our target performance for each round of the simulation. So we focusing on both operational and financial targets. By setting this target early, we had a clear benchmark for measure actual performance.
Hello, my name is Raymond, and I would like to talk about the analysis of changes in every round. So firstly, there is a pricing adjust. It means that we keep on track on every single round so that we can compete with other competitors as well. And second, it's expanding or reducing production. It means that in every round, we expand or reduce the number of production or allocation so that we don't have any leftover material. Also, we look at the raw material per case as well so that we don't waste any material that we buy. Also, we have the marketing adjust as well as the research and development adjust so that in here we can keep on track by the status of our product image and product quality so that we will not be left over by the other competitors.
Hello, my name is Stefan. Now, I'm gonna explain about the decisions that we made during the competition. Now, first of all, in the first round, we expected quite a huge potential demand. So that's the reason for the high product requests for allocation. And from what we learned from the two previous simulation days, we normally do great if we set up with $500,000 marketing expense and R&D expense, and also a $300,000 equipment maintenance expense, and also $150,000 equipment investments. After that, we normally purchase the raw material in the first round in bulk. So in the next round, we only have to purchase a little bit, like a fraction of what we will have to purchase in the beginning. And from what we learned from the previous games and the simulation day, that is normally enough for us to sustain until the final round. But as you can see in the bottom table, we have the actual results of each of the rounds, and round one was quite a surprise, which we ended up with a negative net profit, which is with a negative 800,000 net profit. Now, from our analysis, the main reason that we lost a lot of money is because that we expected too high of a demand, and the 800,000 that we requested didn't have enough cash to make all of the products that we wanted. And also we have a lot of product that is lapsed. If I'm mistaken, we have like 300,000 in finished products that we haven't sold in the end of the first round, and that also added up to our net negatives. And secondly, we focus on getting our product image up, but also our product quality up. We try our best to not lose our competition with this product image and product quality, because from what we learned, it is very influential in the total demand that we would gain in each round. And as you can see from the bottom table, in the second round, we already managed to get a product image of 2 with a product quality of 0.38. And from here, we would normally hold back on the marketing expense, so we can allocate the funds into something else like the R&D expense. As you can see from the top table, the marketing expense, it's only done 250,000, but we did a miscalculation, so that resulted in our product image taking a huge hit, right? So it decreased to 1.45. So in the next round, we actually have to put more expense into the marketing expense, give it a higher budget so we can actually cover the product image. And in my opinion, that is one of the reasons why we that our net profit isn't as high as we hoped. The maximum net profit that we have in the games is around 300,000, while having an average about profit about 200,000.
Hunter team, your time is up now. We have to move to the Q&A session.
Okay. Is there any questions?
Mhm. I think you have done well by looking at your presentation. You started with the losses, and therefore I can see your owner's equity went down, but then it continues to go up and finally reach back to about the starting level. I think overall, your company would probably be still making losses in the 5 rounds. So your owner equity has reduced, but still, the good thing is it's improving. I look at one thing, I observe one thing, and I want you to explain why you invest $0 for raw material in round 3.
Okay, sir. Okay, sir. So if we see the decisions that we made in the previous round, we already bought 1.5 million raw materials that we purchased. But in the first round, we have like 2 and 2.1 million raw materials that we haven't used for the production. So that's why we feel like it's better off we just hold off. We don't buy the raw materials because we're at a big net negative profit. So we decided that we have enough materials that we can last at least a couple rounds in the front with a couple rounds ahead without needing to buy a huge amounts of materials. So we decided to decrease the amount of raw materials we need to purchase. So we have enough. We have other funds, so we can allocate them to other more important categories.
Now, actually, a good manager does not do erratic decisions. So, you do not suddenly invest nothing, and then you suddenly invest millions. So this is not a good management practice. And even if you think you have already sufficient raw material, it should be a phase down process and not just zero, because then you probably will have a hard time then in round 4. Now let's see your dividend. So round 1 you pay dividend, and then no dividend, and then round 5. What was the decision process? Why did you decided to do a dividend in round 1 and then no more in the succeeding round, and then suddenly a lot in round 5?
To be honest, sir, we plan on issuing out our dividends routinely, like maybe 100K to 200K every round. But since the first round we did very poorly, it resulted in our owner's equity being less than $10 million, which the game didn't allow us to issue any more dividends. So once we get to the round 4 and 5, we have owner's equity that's higher than $10 million. Then we're allowed to issue our dividends.
I see. All right. So you pay dividend round one, you didn't know you're going to end up with negative net profit. But when you saw you have a negative profit, then you stop dividend until you build up.
I'm sorry, sir. May I correct? It's because even if you have net negative profit, I would preferably, if I can, I would still issue some dividends. But because our owner equity is less than $10 million, the game wouldn't allow us to issue any dividends. So it isn't like our choice. It's designed. The game didn't allow us to issue any dividends if our owner's equity is below than $10 million.
I see. Okay. I leave the other judges to ask questions.
Sorry. So what I can see here, like in the first round, your net profit is negative. But then why did you decide to increase your price for the next round? Although like you did well, but what made you decide to increase the price?
Answer the question, because when we look at the competitor's price, it's all around $7.2, and we think that it is a good decision to put that price for our product, because in here we can stay in the competition with the other competitors, as well as to increase our net profit in the next few rounds.
So what did you think that makes it like, although you increase the price, but yeah, you said to be in the same level with the competitors, but what makes it increase your revenue? Okay, that's fine. I think the time is up. Yeah, thank you.
Okay, thank you, Hunter team. The Q&A from the judges is done. You may go back to the main room. Okay, Lovers team, the timer will start when you start speaking.
Sorry, can you start from the beginning of the slide? Good afternoon, SM judges and committees. Today, Kevin and me, Jessica from Lever's team, would like to explain about our strategy for the final round of MBS e-case competition with the title of Decoding the Game Strategic Approach for Market Success. Next slide, please. To start off, we had 4 main buckets of objective, including forecasting sales, production, how we reach the sales, and dividends. Can you please, next slide? In forecasting sales, it is important for us to make sure that we achieve the high market share while preventing under or overproduce. Next, production. In this side, it is important for us to run production as effective as possible. Next, reach the sales. Same thing. We want our production to run smoothly. Thus, it is important for us to be able to decide on a desired pricing, product image, and quality that suits the market. Lastly, dividends. As our objective is to increase our NPV, we would like to give out dividend as early while maintaining healthy cash flow. Next slide. In details, this slide explains our thought process of each objective, starting from analyzing potential demand and competitors by having access to the sales status and business status tab on the MBS platform. This can help us to see the market competitiveness, thus we can decide on the potential demand. Moving on to production, we create a modeling and detailed calculation on our Excel sheet which can be accessed through the QR code to decide on the exact amount of equipment investment, maintenance expense, and raw material requirements. To obtain the desired sales, we're paying a very close attention to the business environment to prioritize factors to achieve our sales volume target, as well as determining the optimal composition to maximize our net profit. Next. Overall, as you can see in this table, this is our every decision in each round, where the details will be explained by my friend Kevin. To sum up, our main strategy is to forecast accurately, efficient in production, and having a healthy cash flow. Kevin, the floor is yours.
Okay, next slide, please. Thank you, Jessica. Now I'm going to break down our key analysis of each round to give you a picture of how we determine our key decisions. Considering the high level of competition of the finalists, we expect to have limited and possibly very low demand. We initially predict that our potential demand is about 550K or less. However, it turns out that the market was more competitive than expected, and we can only have around 30,000K of demand. However, you might notice that even though we experience a loss in profit, our loss is still lesser than other competitors. This is because we already predict that the demand will be much less than usual preliminary or simulations. So when others maybe predict 600K or more, we predict less because we understand the more you overproduce, the more loss you can get. That's why we managed to experience less loss compared to other teams, positioning us in the first rank in the net profit. For the other production and procurement related decisions throughout the round, our decision is based on our Excel calculations. So we will not really deep dive into that given the limited time. For the marketing and R&D, to reach the sales, we think the best strategy will be investing more in marketing than in R&D. For the price, we set the price at 7.20 as we believe it is the most optimal point to maximize profit without significantly harming the demand. However, due to unexpected low demand, as explained before, we experienced a loss of 500K. Next slide, please. For the next round, we analyze the potential demand that we could get. In this round, with expectation that the market is growing in each round, we expect the demand could rise to 425K. Given to loss experience in the last round, our focus remains on optimizing net profit. Therefore, given our competitive position, we reduce our marketing and R&D expense to level needed to meet our demand forecast. As a result, we accurately predicted our sales volume, indicating that our marketing, R&D, and pricing strategies were operating at its peak effectiveness, resulting in most profit in the group. Okay, next slide, please. For the third round, again, we expect the market to grow. We project the demand could grow to 550K. To reach that, we analyzed that given that our product image has reached its maximum while R&D has not, we adjusted the allocation between marketing and R&D expenses. For the prices, we decided that 7.2 is still the optimal price to maximize profit without harming the demand. However, it turns out that our marketing and R&D effort is not enough and were outperformed by other competitors, resulting in failing to reach our target. However, we still delivered a solid net profit. For the fourth round, next slide, please. With the market expected to grow again, we projected our demand at 600K for this round. To reach the target, noticing that our product image lagged behind competitors, we decided to increase our R&D spending. We also lowered our prices to boost demand and improve competitiveness. As a result, we successfully predicted our sales volume right, so showing that our strategies were performing well, resulting third rank in most net profit in the group. For the last round, with the market expected to mature, we projected demand at 600K for this round. Carrying over 10K finished good from previous round, we initially planned to produce 590K. However, due to an error in our calculation and Excel sheets, we mistakenly entered 551K for allocation instead of 590K needed. To reach sales forecasted, we decided to enhance our product image a little bit more through increase R&D investment and set the price at 720. As a result, we should have generated a potential of 600K. However, due to an error in inputting our decision figures, as previously explained, we were unable to maximize our potential.
Okay, as our decision goes, this is our performance result in each round. Based on the table, it can be seen that most of the numbers are positive, indicate that most of the time we could achieve net profit. This can be done because we had an accurate composition of revenue and costs by setting the right amount of expenses, meaning that we did not overexpense or underexpense, just enough to get what we want. Next. To conclude, we successfully align our initial objective to forecast accurately, produce efficiently, and to maintain a healthy cash flow, showed by this management objective. In forecasting sales, except for round one, we managed to minimize the occurrence of having overproduced or underproduced. For the production side, our production decision has been calculated, so there is no production failure, except for slight error in round 4. But we always calculate everything, including the cash flow that we had. To achieve sales, the right composition of expense, and being efficient and effective throughout the round, we achieve net profit for each round except for round 1. Therefore, we end up winning first, with our NPV stands for $93,820,000. Next slide, please. And that wraps up our strategy in this final game. We, from Levers team, signing out. Thank you.
Thank you. Actually, I'm quite impressed with your results. There's some concept or equity.
Not considering the table, the data table, but our objective is clear. And the management objective, the template that is provided by the Top-BOSS team is actually aligned with our objectives. Like, for example, we can say, let's wait for the slide first, maybe. Yeah, the template that was given is I modified a little to align it with my own objective, which is like for sales volume and inventory finished good data is aligned with our objective in forecasting sales. We want to get the most demand that we could get, but also making sure that we are not going to overproduce or underproduce, because if we are going to overproduce, it's going to be a loss, and the same goes with underproduce. There will be many opportunity costs that we are not maximizing our potential. And for the expense investment, production volume, and inventory raw material expense maintenance is aligned with our production goals, which is just making sure that our demand. We have our own target demand for each round. We're just making sure that there is no constraints in producing those demands. So these objectives, these numbers provide an overview that we managed to fulfill our demand. We managed to produce all of our targets. So, and then the right side, the expense marketing, the expense R&D, our revenue, and net profit is aligned with our reach sales objectives, which is we want to get the most demand as much as possible, as close as the potential demand as possible, and our composition of marketing expense and R&D expense resulting in positive net profit shown in the slide. We actually have constantly having a positive net profit besides the first round, which is all of the team in the group have a negative profit. But even in the round 1, we have the most less loss in the group. So yeah.
Okay. I like your answer. I also look at now the slide you show. If you say the objective is no investment in the equipment for the first 3 rounds, 0, 0, 0. Then 3, 4, 5, you decided to target something. So why was the initial 3 rounds without any investment on the equipment capacity? What is in your thinking?
Oh yeah, I'll try to answer. So in the first round and the second round, we noticed that the maximum production that we could get is 600, and maybe in round 2 is going to decrease to 580. But we don't invest in equipment because we expect that we are going to produce not bigger than that. So why would bother to invest further? Because our safe place, our comfort zone is actually playing in the 600 demand. So we're equipment investment that is spent on this is actually just to make sure that we are able to produce 600K. So when in the round 3, when the maximum production decreasing and we need to produce 600, we make sure the equipment investment is also can fill those gap. So, and one of the reasons why I don't like I don't expense earlier, because on the first round and the second round we can see that many people lost experiencing a loss. So it damaged those cash flow, but because we didn't invest any equipment investment, that's a result a healthy cash flow. We don't have any overdraft. We have a good cash flow. Yeah. So that's my answer.
Oh, very good answer. All right, I'll leave it to the other judges to ask you questions.
Okay, I want to ask about one thing about expense maintenance. What is your consideration to make it bigger in the round 0 and then lower in the next round? Because I think maintenance usually in production is bigger after several years of production, for example. So what is your consideration? Thank you.
Oh, sorry. Can I still answer?
Yes, you may answer it with a short.
Okay. I'll try to answer this maintenance expense. Yes, I know. Actually, in a real life scenario, maintenance expense is very important. But in this particular game, I find it hard. I struggle a lot in predicting the effect of the maintenance effect. So the maintenance effect is impacting the labor cost and the conversion rate. But somehow I didn't find any kind of formula that managed to calculate those. So when in this game, when we can't really quantify the effect of maintenance expense, why bother investing much on this? But still, we realize that maintenance expense is very important. So we think 50K is enough to just make the conversion rate number is just smooth as possible.
Okay, thank you, Labers team. What a great presentation. The Q&A from the judges' time is done. You may go back to the main room. Okay, Sawadee-Kap team, you may present your presentation.
Okay, committee, thanks for the opportunity. Let me share my screen first. Is it visible to everyone?
Yes.
Okay, thank you.
Okay, I'm gonna start the presentation. The goal is not to be the cheapest. The goal is to be the most valuable. That's what business strategist Ron Baker once said. Good afternoon, judges. We are from the Sawadee-Kap team. I am Mita Sihotang, together with Jonathan Andrians, Haris Maulana, and Pratisara Kansa, will present our strategy to win this game simulation by maximizing product value, strengthening market position, and ensuring cost efficiency to outperform the competition. Let's start by understanding our internal and external environment. As you can see, our marketing effect and maintenance effect are high, while the R&D and price elasticity are moderate. This insight directs our focus toward building strong product quality and image, while also optimizing maintenance to control the cost. Connecting this to the market landscape, we operate in a saturated market environment with 10 companies offering a single product in one market. With competition at a high level, anticipating competitor moves become essential to maintain our position. And looking at our current performance from a financial standpoint, we have $10.8 billion in assets with over $1.1 million in cash, which give us the flexibility to invest strategically where it will have the most impact. Bringing these points together, our objective is clear. We aim to gain a competitive advantage through high product quality and achieve cost efficiency, so we can offer competitive prices without sacrificing margins.
For round one, our strategy balanced cautious market entry with strong product positioning. We set our price at $6.8, adopting a wait-and-see approach while monitoring competitors. To build brand perception, we allocate $450,000 each for marketing and also R&D, ensuring both strong market presence and also product quality advantage. We invest in equipment to expand capacity and in maintenance to improve conversion efficiency. Finally, we allocate $300,000 for dividends to maximize NPV early. Overall, our round one objectives are clear. It's to secure a strong product image, increase capacity and efficiency, and deliver high shareholder returns. In round two, we shift gears from expansion to precision. We raise our price to capture more value while ramping up marketing and R&D to strengthen brand presence and product advantage. Production is scaled back to avoid excess inventory, and raw material purchases are trimmed to match. We hold off on new equipment investment, focusing instead on our current operation efficiency through maintenance. Dividends take a back seat this round, with all resources redirected toward building market strength and sharpening product quality. The focus are leaner operation, stronger positioning, and a higher profitability per unit. In round three, we adopt a defensive stance. With seasonality working against us, we hold prices steady to protect market share. Marketing spend rises to keep our product top of mind, while R&D remains strong to maintain our edge for future rounds. Production is trimmed again, focusing on moving existing inventory rather than building more. Raw material purchases are kept just enough to sustain operation. With no new investment in equipment, maintenance is also cut, as our current inventory levels reduce the need for maintenance expense. Dividends remains on hold. Every dollar stays in the business. The core play this round are control costs, manage inventory, and ride out a weaker season while protecting long-term competitiveness.
Next, in round 4, we raised the price to $7.15 to leverage our revenue. Marketing spend was reduced to $500,000 as brand image remained high. We produced 597,000 units and maintained raw material levels. Equipment investment increased to $250,000 and maintenance to $250,000 and maintenance to $150,000 to boost our capacity and efficiency. Research and development stayed at $450,000 to ensure our quality of the product. No dividends this round, focusing on growth for future long term. Next, in the 5th round, we set the price at $7.25, supported by a good seasonality index and lower product quantity. Marketing spend was reduced to $450,000 while keeping strong brand presence. We produced 599,059 units to maximize capacity and target competitor demand. Material purchasing was adjusted to 425,000 units to match our inventory needs. No spending on equipment or maintenance this round to cut our costs. Research and development increased to $550,000 to secure our quality and advantage. We allocate $100,000 for dividends while supported by a healthy financial.
Our strategy was clear from the start. Build a solid foundation, then accelerate. We invest boldly in R&D and marketing to strengthen product quality and brand image in crowded market. When growth started to level off, we shift from playing it safe to going smart aggressive. Every decision, from pricing to production, had one purpose: turning our financial strength into market leadership. By adapting through each season and multiple management system, our strategy will be successful in enhancing the company value. Sawadee-Kap team welcomes the company to use our optimized strategy. We are very open to answering all the questions. Thank you. Sawadee-Kap team, ready to win.
Thank you. Thank you for the presentation. I have some comments to start with, because you did not follow the instruction. So the structure of the presentation, you did not show your business management objective. You have not shown your performance progressively round by round. Even in the presentation of the decisions you made in the round, you are breaking it down so the judges cannot see the progression. But in spite of that, I noticed something, because I saw a lot of $0 investment, for instance, equipment. Round 2 and round 3, nothing. Maintenance also, I think, if you flash back. So definitely a good manager, a good management is not erratic. You suddenly do nothing and then you suddenly do something. So I like you to explain what was behind your thinking at the time when you decided to invest nothing in some of the in the equipment and maintenance.
Okay. Thank you, Judge, for the question. We do notice that our equipment investment and maintenance expense in several rounds are zero. And this is deliberate. Why? Because we see that we have a lot of finished good inventory coming from the first round. So we don't need to actually produce a lot of new finished goods. We can use the existing finished goods, so we don't really need a huge capital expenditure for our equipment investment or even maintenance expense, because we also have a lot of raw material inventory. So we deem that the more important thing for us is actually to increase our net profit, to actually cut costs. So we deem that where we can cut costs is actually in equipment investment and also in maintenance expense.
And did you set any objective since you never showed? Did you set the objective of what you want to accomplish each round?
Okay, so we actually we don't really show in this presentation, but in the game itself or in the simulation itself, we already make some management by objective, and we also made several progression with our net profit. In the first round, we posted a loss. In the second round, 2, if I'm not mistaken, but beginning in the third round or in the fourth round, we started to actually gaining up net profit, and we get what our objective wanted. And in the market share itself, we always set our objective at 11%, and we already achieved this, because each round we always achieve 11% or even more market share, unless in the fifth round where we got 10.5%, but it's still good enough.
Other judges?
So did you get any, do you have any positive net income, net profit?
Yes, we actually posted a net profit in the fourth round, and also in the third round, and in the fifth round. We started posting a net profit starting from the third round until the fifth round. And this is our strategy itself, because we want to actually increase our product image and product quality, and we get what we wanted in the third round and after that.
Okay. What do you think like that makes you get positive net profit starting from the third round? Which strategy that you think helping you get the positive net profit?
Okay, thank you for the question, Mrs. Nurdaini. We said in this third round at the zero investment on maintenance expense and dividend, because we're realizing, and before this, or which is it's round 2, we have a minus or net profit. So in the next round, which is round 3 is now, we instead increase our pricing, marketing expense. We invest more a lot of, especially on the marketing expense and R&D, and then we allocate the cost from the equipment investment and maintenance expense, because on the previous round, we already have some investment for this aspect. And then because of we allocate this to marketing and R&D expense, we create and keep maintaining our market share at level of 80% at each round. So we keep maintain our market share, keep stronging, and then keep our sales revenue is increasing. So that's why in round 3, 4, and 5, our net profit is increasing. And then in the 5th round, because we have positive and healthy financial condition, we can share again our dividend.
Why didn't you start giving dividend on the third or fourth round?
Okay, because let me explain from the starting first. We share the 300,000 of the dividend because the impact of dividend in the first round is really impactful. But then we're realizing at the result of the first round, our net profit is minus, so we can share our dividend because our owners of equity is below 10 million. Then from the round 4 until 5, we maintain our healthy financial statement so we can share our dividend again. And that's why we have some efficiency, especially on operational expense or material processing. And we'll keep maintaining that and then make sure our stocks is fulfilled by our potential demand. So we don't have any much cost goods from the previous round or stocks from the previous round.
Okay, thank you.
Okay, thank you, Sawadika team. The Q&A session has done. You may go back to the main room. Your 7 minutes starts when you start speaking.
Okay. Good afternoon, our honorable judges. We are veteran painters, and today we are excited to share our journey into the macro business simulation presented under the theme Turning Potential into Performance. Our approach is anchored on 3 core pillars: setting prices based on seasonal indicators, using competitor benchmarking to guide non-pricing decision, and ensuring the consistent maintenance of positive cash flow. These 3 pillars shape every decision we made throughout the simulation, enabling us to address key challenges, remain competitive, and achieve results that are both strong and sustainable. In summary, our performance trajectory reflects the discipline and caters to guide pricing decisions across varying demand conditions, ensuring an optimal balance between margins and sales volume. Competitor benchmarking inform our non-pricing decision, enabling us to maintain competitive product quality, strengthen brand image, and improve operational efficiency. At the same time, careful cash flow management kept our liquidity healthy, allowing us to achieve positive cash flow by round 3 and sustain it before net profit turned positive. This combination of strategies allowed us to resolve key issues, maintain a stable market share, and lay a strong foundation for long-term profitability.
The macroeconomic environment we faced was defined by high inflation, moderate price elasticity, and a significant influence from both marketing and maintenance activities. Among these factors, the seasonal indicators serve as our primary guide for pricing decision. When the index rose above 100, we increased prices to maximize margin, while a drop below 100 prompt us to lower price to protect sales volume. This market condition demand agility from our team, requiring us to adjust not only our pricing, but also our operational priorities and marketing strategies in every round. From the very beginning, we recognized 4 key strategic issues that shape our approach. First, our product image and quality were low, which weakened our overall competitiveness. Second, we needed to find the right balance in pricing. Setting prices too high would reduce sales volume, while setting them too low would erode our margins. Third, we faced the risk of overcapacity, which could lead to high fixed costs if production capacity was not aligned with market demand. Finally, accurate demand forecasting was essential to avoid both overstock and stockouts. To address these challenges, we relied on seasonal pricing to tackle the pricing and forecasting issues, while competitors' benchmarking allowed us to match or even surpass rivals in quality, image, and capacity. At the same time, careful cash flow management ensured that we remained liquid even during periods of heavy investment. Each round, our decisions were firmly guided by the three strategic pillars. For pricing, we set round 1 at 7.2 and increased to 7.4 in round 2 to capitalize on a seasonal index above 100. In round 3, when demand softened, we reduced the price to 6.4, then raised it again to 7.3 in round 4, before holding steady at 7.2 in round 5. In marketing and R&D, we made heavy early investment to accelerate brand development and quality improvement, allocating up to 600,000 for marketing and 500,000 for R&D in the initial round. Our capacity and maintenance decisions were closely aligned with competitor moves, ensuring we avoided idle capacity while maintaining operational readiness. Finally, by managing raw material purchase and timing our equipment investment carefully, we achieved positive cash flow by round 3, even before net profit turned positive.
We closely monitored competitor actions in every round to ensure our decisions stayed relevant to market conditions. In round 1 and 2, major players such as Sawadicap and Ribbon Ridge made aggressive moves to improve product quality and image. In response, we matched their marketing and R&D efforts to prevent the gap from widening. By round 3, while some competitors maintained higher prices, we lowered our in line with the seasonal index to capture additional market volume, resulting in a sales surge to over 600,000 units. This consistent benchmarking ensured that none of our decisions were made in isolation, but rather as a deliberate responses to competitor behavior and overall market dynamics. As a result of our strategy, product quality rose sharply from 1.29 in round 1 to 1.76 in round 5, while product image achieved the maximum score of 2. Throughout the simulation, our market share held steady with the 10% to 11% range, reflecting consistent competitiveness in the market. From a financial standpoint, we generated positive cash flow as early as round 3, even though net profit at that point remained slightly negative. But profitability returned in round 4 with 152,000 and strengthened further to 281,000 in round 5. The performance demonstrates our ability to sustain operations and fund strategic initiatives well before reaching the profit. Seasonal pricing played a direct role in sharpening our demand forecasting and production capacity decisions. Non-pricing decisions such as marketing, R&D, and maintenance were guided by competitor benchmarking, ensuring that our market positioning remains strong. Cash flow management acts as connecting thread between all these elements, safeguarding liquidity and allowing our strategy to progress with a reinforcing cycle. Accurate pricing led to optimal volume, which generates healthy cash flow, enabling continued investment in brand and quality.
In conclusion, Veteran Ventures can successfully transform potential into performance through a clear data-driven strategy, leveraging seasonal pricing to capture demand patterns, applying competitor benchmarking to maintain both relevance and competitiveness, and managing cash flow to ensure long-term sustainability. This integrated approach enabled us to address all key issues, and turn early losses into sustainability, profitability. Thank you for your attention, and with that, we return the session to the moderator.
Can you keep the slide before this? Thank you, so I can see your overall some of the performance. I want to see the slides there. Move the slide up.
I'm so sorry, but I couldn't really hear your question. I'm sorry, Mr. Chi.
The slide now is the last one, but I want to see the previous one. Yeah. All right. So at least then I can ask questions based on that. So this is your stated objective. But is that also the actual performance, or this is really an objective that you set? For instance, if it is an objective, then I should not be seeing a lot of this. The last 3 digits should be 0. It cannot be so accurate. So what is this objective that you are showing me?
Okay, so I will try to answer your question. So our main objective are at the first round, we try to increase our product image and our product quality. And after we hit a certain numbers, and because this game is actually heavily influenced by the high performance of marketing and campaign, so we want to achieve a high number of product quality and product image. And after we achieve that high number, we try to maintain our positive cash flow so that the resulting of our decision are not affecting the cash flow negatively, sir.
I think this slide is not. It is the actual performance rather than the objective you set. But I would like to see how the objective changes, because as you see the actual performance, the results, and the circumstances changes. So you will continue to adjust your objective to meet with the new situation. And raw material, you have got high purchases, and then gradually going down, and then gradually going up. But are you certain that this level of inventory of raw material is necessary? Have you done any analysis that it is necessary for your operation, or is too much?
Okay, so yeah, my teammate and I think that this raw material is necessary because we try to meet the potential demand. And how we meet the potential demand is we calculate our finished good inventory with our raw material inventory, and then we also add the raw material inventory with our raw material purchasing. And after we add those numbers, and we will multiply it with the conversion rate. And after we get the numbers, we then decided on how much will we produce based on our raw material, and then the material that we are purchasing. So we try to meet the potential demand, but we don't want too much finished good inventory. So I think the raw material is very necessary.
Judges?
Yes, I want to ask about your consideration in delivering the dividend. Can you move to the slide related with the dividend, please? Yes. I saw from your slide here that you give the dividend only in round 0 and round 1, and there is no dividend after that. So yeah, maybe can you explain what is your consideration related about this decision? Thank you.
Okay, so for the base round and the first one, we try to keep the dividend up with the demand, uh, demand, but in the next round, we don't have enough equity, so we cannot keep sharing the dividend. Also, okay, I think that's all from us. Thank you.
Okay, thank you.
Mr. Michael, do you have any questions for this team?
Okay, yes. From what my observation, your market share among the team is okay, above average. Okay, but the inventory level is pretty high, at least in the level 2, 3, 4. So have you think about how you can synchronize your production allocation with your potential demands? Otherwise, you need to suffer from a lot of holding costs in your warehouse. Yeah, maybe you can give me a short question, a short answer? Thank you.
For the market share, we actually cut our price in the last price were too high, so that's why we cut it in the last round, and it actually turns out that our market share being better. I think that's all from us.
Okay, thank you.
Okay, thank you, Veteran Venture team. The Q&A from the judges' time is done, so you may go back to the main room. You may start the share screen for the presentation slides. The timer will begin when you start talking.
The presentation will start in 3, 2, 1. Good afternoon, honorable judges, committee members, and our competitive friends at MBS competition. We are Team Begins, consisting of me, Aidil Akbaruddin, and my associates Ananda Wahid Rajat, Mujib Harisaya Rambang, and Moh Amil Habib Karib. We are pleased to present our work for the MBS competition. The market is highly competitive, with comparable pricing and market share among rivals. Our strategy focuses on maintaining reasonable price while protecting market share. This approach enables us to achieve the highest equity in the final round, securing the top score in SCFR, ranked second in sustainability, and placed fourth overall. The scoring criteria differ from the preliminary stage. We will against 9 other teams across 5 rounds with the possibility of additional rounds. Accordingly, we have prepared contingency plans to ensure we remain adaptable should the competition extend beyond the initial.
Marketing expense at the beginning to occupy the share.
Then we preserve the R&D expense at the constant rate to keep our business prospect. Next.
For the production strategy, we maintain material inventory above 1 million units to ensure availability and production continuity. It can be seen that we have successfully maintained sales from growth up to round 5. We also purchased 800,000 units of raw materials in the 5th round in anticipation of a possible 6th round. Next. Based on the strategies we explained earlier, here is a summary of the decision we made. We emphasize maintaining marketing expenses at a high level and R&D at a constant level, in line with our environmental analysis. Next. With this strategy, despite a dip in round 2, we record consistent and generally upward performance, especially on net profit, revenue, and product quality. Our revenue increased from 2.4 million to 4.8 million in round 5. And our product quality improved from 0.29 to 1.03. Next. Here is a comparison between the decision made and the performance achieved by our team. Every result we obtained in each round was used as a reference in setting our MBO.
Next. From the MBO forecast, our actual market share consistently met or exceeded our forecast. This is a great indicator that our competitive strategy were able to capture and maintain a solid position in the market. For inventory turnover, we had some initial challenges. Our actual turnover rate was below our forecast. However, we successfully adjusted our inventory. Next. For revenue, our actual performance significantly exceeded our forecast. This indicates that our strategy for market penetration and sales were successful. On the right side, for expense rate, initially our actual expense was higher than our forecast, but we were able to bring it down over time. Next. As you can see from the previous chart, our revenue has shown consistent and strong growth. Our net income also shows a positive trend. While we started in a negative position or loss, we successfully moved into profitability and continued to increase our net income throughout the simulation. Next. Finally, let's summarize our overall results. Our performance was evaluated across several key metrics, each with a specific weighting. Our NBV was 31.6, fill rate was 15, revenue growth was 14.55, TIE was 5.7, and ROCE was 12.3. These metrics combined give us overall score of 79.15. Based on this score, our team finished in 4th place out of 10 teams.
In summary, our growth-focused strategy has delivered measurable success in a highly competitive market. By continuously adapting our dynamic approach to evolving market conditions, we have transitioned from a negative net revenue position to securing first place in the net profit by the 5th round. This outstanding performance positioned us as the leading equity holder in the final round, and overall, we achieved a 4-position improvement across key performance metrics. For the conclusion, we believe that sustainable growth was more profitable to adapt on a business than the other strategy. Thanks for listening. The progress we've demonstrated puts us in a strong position and we're ready to win the competition. And good afternoon.
Okay, can you display that slide on management objectives? I want to comment on that. Just go a few slides back. Yeah. All right. Now, one thing I would like to comment on is that this is not the objective. Objective should be in big round number because it's only the objective. But actually, what you achieve, yeah, will be in the more details, right? But I want to ask you to explain your actual performance. This is the actual performance. How far each round from the target that you are aiming, your objective. So, you know, you may not actually have the thing that you show is not objective, but you should have some idea what are you trying to achieve in each round, and then when the result comes out, you tell yourself, yeah, I achieved it or I did not achieve it. So which objective you thought you have well achieved, and which objective which you think you have a problem achieving, and actually you have to change your objective.
Okay, so I will answer the question with my colleague. The objective we focus is achieving maximized profit with sustainable growth. And the problem will be explained by my colleague.
Okay, maybe let me explain our model or our strategy to win this game. So we made some simply model of the game, and we try to achieve our decisions in the final round this time. But we believe that the problem is because this is a live competition, and we see that the other competitors have the more strategic pricing. We do not expect that our production request and allocation is not meet the potential demand. So it's why when we try to calculate this, we found that our finished goods inventory is bigger than we expected. So if for the next round, we try to increase our potential demand by increasing our marketing expense or R&D expense and giving strategic pricing than the others. Like the one is we stick our price under the average level of the price of the other price.
Okay, I like it. I think a good team would already develop their own spreadsheet that will help them do the calculation to make their decisions. So that's a very good thing that you have learned. So can you bring to the performance slide again? Yeah. Now, so from the net profit point of view, you finally make it at the last two rounds. So that is to say, you are doing a very good recovery, and your equity drop obviously, but you are able to maintain. Also, sales revenue is growing, market share, and all this. So overall, which was the breaking point that you find that it is the time that you come out from behind and now raise the head? Which round is your breaking point?
Okay, so for the strategy that we made the profit in the front part is that we increase our marketing expense and the product quality of the decision that we made, because the product quality and the product image is increase the sales volume of our products. So we increase the product image on the product quality, and then its result that in the fourth round, we can get the product quality in second place, the best second best product quality of the image.
Okay, so additionally, we on the first round we just don't expect that we achieve that net profit. So On the second and the third round, we analyzed our competitor, and we found that the market is so competitive with similar price and similar market share. So it means that our marketing expense and also our R&D and so on is also the same. So we just need to ensure our inventory, which we almost achieve accurate forecasting, and that's mean we just need to follow our strategy.
May I ask one question? I kept seeing your team have a lot of inventory, right, throughout the rounds of the game. So have you ever think about what else you can do in order to optimize your profit but reducing your inventory level?
You may answer with a short
All
answer.
right. With our high inventory, because we just don't meet the expectation on the first round, we believe that if we achieve to sixth round, we're gonna sell our inventory at a lower price with our high market share, and our marketing expense will be higher from the last round. We believe that we can sell that inventory, but alas, we don't see the sixth round. So yes, it seems that our last round strategy, although we achieved the highest NPV, the highest net profit and also highest equity, our effort to successfully to go to round 6 is failed.
Okay, may I share with you my suggestion is that because I saw you overestimate your potential demand throughout the game. So maybe in the future you can consider whether or not you can increase the selling price. With that said, the potential demand would drop, right? Because the potential demand actually in this game the production volume is constrained by the production capacity, right? Which is about 600 something, right? But maybe not up to 700,000. So with this in mind, so you may have a problem to optimize your profit margin. So that's why my suggestion to you next time is that maybe you can consider to increase your selling price by having less potential demand, but higher profit margin as well. Okay, thank you very much.
Okay. Thank you, Andrew.
Thank you.
Okay, the timer will start when you start speaking.
All right, thank you so much. Imagine running a company where the market changes every season, competitors move aggressively, and one wrong decision can wipe out your profits. That was the challenge we faced in the MBS e-case competitions. Good afternoon, everyone. We are from the Veteran Jaya team. I'm Anantia, and there's my teammate, Raina, Gita Dinda, and Nehemiah. And today, we'll take you inside our journey and navigating this high-stake environment and the strategic move we made and how we turned early setbacks into market leaderships. So the first one is our business goals. So our goals were clear from the start, which we are focusing in effectiveness, which we want to achieve productions, inventory, sales efficiency with steady revenue growth. And the second one is product quality and image, where we want to ensure high quality products, strong brand awareness, and effective distributions. And the third one is profitability, where we want to deliver positive revenue and profit growth consistently. And then nextly, we have the key issues and challenges. However, there are several key issues that we have to face, which we operated in the highly competitive market, where quick and strategic decisions were crucial to survive. We face uncertainty in demand, requiring to satisfy customers without harming profitability, and we have to balance revenue growth with maintaining a positive net profit, which with a challenge.
So our decision were based on two constant evaluation, and number one is business environment analysis, where in the business environment we tracked the economic growth, seasonal indicators, and age aspect indicators. Next, please. And then our financial analysis is before every round to a comprehensive financial calculation to calculate the overall projection, include revenue, net profit, and inventory. Next slide, please. Okay, in round one, we have goals to maximize production capacity and keep inventory ready to meet demand. And then the result of round one, we face a loss net profit. The competitor analysis showed room for market penetration, so we push sales more. Next, please. Okay. To minimize the loss that mentioned before, in this round we focus on brand awareness and product quality by increasing the marketing expense and also increasing our price and using available inventory for best delivery. Next. For the decision in the round 3, from what we analyzed, we found that market share wasn't optimal and product image was still low. And also we carried a large finished goods inventory with 323K into the next round. In the round 3, the decisions we made were aiming to optimize production capacity, align with demand, and use raw materials efficiently. Okay, in pre-round 4, owner's equity was 9 million. Next, the goal we set from round 4 is we aim exit to 10 million for dividends by maintaining product image and quality, using competitive price to boost sales volume. Next, please. Okay, in round 4, we set the price at 7.2, both 750K materials and produce 650K unit to secure a strong fill rate, while investing in marketing, R&D, and equipment to strengthen our position. Next, please. And from round 4, we achieved second place in market leadership with higher revenue and sales that showing our high demand to our product. Moving forward, our goal is to maintain this position, to push sales and revenue higher, and maintaining enough finished goods to meet high demand, ensuring no missed sales opportunities. Next, please. Okay, in round 5, we priced at 7.3 for both competitiveness and profitability, raised raw material to 850K unit for full production, and aim to secure all sales opportunities while sustaining market share. Next, please.
Despite experiencing a loss early in the season, our strategic adjustments were paid off. We managed to grow revenue and profit steadily and increase our revenue state every round despite facing the reduced net profit in the 5th round due to the lack of inventory. We also strengthened our brand image, optimized production efficiency, and positioned ourselves for sustainable growth in the long run. So that is all. In the end, these competitions is really reminded us of a key business truth. In fast-changing markets, the companies that succeed aren't just the biggest or the richest, but the ones that adapt the fastest. That is all from us. Thank you so much for your attention.
I like to make a comment. I think all of you received an instruction as to what should be the structure of your presentation. And now your presentation actually does not conform to the structure that I prescribed. I want to see how the performance vary round by round. I want to see how your decisions vary well round by round. Now, your presentation does not show me that. So therefore, it's very confusing as a presentation is concerned. Now, if this final line is of any value, the print is also very small. I see that you have finished good inventory at the last round. That is 0. So can you explain how you end up with a 0 finished good inventory in round 5?
So thank you so much, Mr. Ching, for the questions. So it is actually pretty unexpected for us because while we are actually projected it before, and we projected to have the remaining finished goods inventory for these rounds, but we know the risk since we have pretty limited raw material sources in the previous round in order to keep our company to fast increase revenue. So from the rounds 1 to 4, we kept some stock as a backup to meet the demand. So in round 5, we sold all the remaining stock from round 4, and based on our calculations, could only produce around 630K units and calculated from the raw materials and the conventional rate. This way, we fully use our resources, met the market demand, and avoided the extra storage costs. While at the same time, in the round 5, we did increase our material purchase as part of the next season's round 6 production projections.
Okay. So do you understand the implication when at the round 5 you have no finished good inventory? What could it mean to your business in round 5? In other words, you empty your stock. So what does that tell you? What is the implication?
So we sell out. It's actually because we sell out all the finished goods inventory in the round 5, while actually in the previous round, in round 4, we already estimated it that we will use our remaining inventory goods in our inventory, which is 20K. And then we made projections from our remaining raw material in that time around 900 or 800K raw material, and we wanted to use all those and maximize our resources to meet the market demand. And then we did projected all those projected all the market demand to until the finished goods. So it is like the first thing we did is doing the projections, and then we do know the risk that we may have zero finished goods by the end of the round 5 if we met the market demand in the round 5. So it is actually we bought pretty high or higher raw material purchasing in the round 4 in order to manage to making finished goods inventory in the round 5. But however, we met the potential demand and the market demand, so all our finished goods are sold, Mr.
But do you realize that that means in round 5 you might have actually better business, but then you don't have the finished goods to meet the demand. You created the potential demand, but you are not meeting those potential demands because in your stock you're just not having enough product to meet the demand. And the reason why you end up like this is also a bad decision in round 4. It's probably because you also don't have enough raw material. Even if you ask for the production, then the raw material is not sufficient. So just a quick question. In the overall performance, did you end up with an overdraft? Because now I cannot see. Do you have end up with an overdraft and in which round?
I apologize. Can you repeat the question, Mr. Ching?
Your financial performance, would show everything, right? I suspect you have an overdraft, but of course, I cannot see. So I'm asking you to confirm whether you had an overdraft during the game. In other words, you're forced to borrow money.
Okay, so we did actually have a loss in the early of the round, but we are gradually managed to overcome this problem in the next round gradually from like in the first round. I believe that we were facing a loss until 700K, and then we gradually managed to reduce the loss in the round 2, which we reduced it until we have loss in 2000K ish, and then in the round 4 in the round 3 we then managed to have a profit margin to increase. We managed to increase our revenue until the 5th round.
Just give you some. I asked if you had an overdraft, and since you are managing the whole company, you should know whether you have or you didn't have. And the fact that you are not answering me spot on, that means you are not looking at the financial statement. So next time, be more diligent in analyzing your financial performance. Okay, thank you.
Thank you, Mr. Ching.
Okay, Veteran Jaya team, the Q&A session has been done. You may go back to the main room.
Good afternoon, Mr. Ching, Mr. Michael, and the MBS committee. My name is Alexandra Melinda, with my teammate Francisco Stefano Raditya and Lydia Malita, representing Team MFY Spectra. Today, we would like to present our strategy and analysis to the simulation. Next. Our main goal is to maximize our profits and strategically place our expense. Next. Our strategy has a clear order of priorities. First, we focus on building a strong product image so that our product is recognized and stand out in the eyes of consumers. This is about creating awareness and making a lasting first impression that attracts people to try our product. Once the product is known, we move to our second priority, improving product quality. This ensures that consumers not only try our product, but also come back to buy, because they are satisfied with its quality and performance. Next, we prioritize balancing production capacity with maintaining inventory. This means making sure our production capability is sufficient and that we always have enough stock. That way, when demand increases, we can meet it smoothly without delays or shortages. And finally, we reach the stabilized stage, where we focus on keeping everything consistent, efficient, and sustainable, ensuring long-term growth and stability for the company. And then our end goal is to clear inventory optimally and meet the demand.
I will now continue with how we decided for our decision making. First, we always start with the round review. How are we doing at the current round, and how our competitors are doing. From there, we check back on our priorities. Which one of the priorities are finished, and ones that we would like to focus on next. Afterwards, we would do necessary calculations in regards to our inventory, production capacity, as well as potential revenue and also potential demand. Afterwards, we decide on the next round action. We plan for the next two turns, especially when it comes to purchasing materials and such. Once we've settled on the conditions that we would like on the next round, we make a decision. Now, these are the decisions that we made so far. We opted for a price that's relatively close to the average. We started very high on the marketing expense initially because we want to increase product image as fast as possible, and then we wanted to focus on product quality afterwards. When it comes to our raw material purchasing, we try to match how much we wanted to produce, and then for production, production request is similar to the raw material purchase. We didn't feel like the need to focus too much on our equipment investment, however, because we feel like we never needed to produce that much as the competition went on. And because of that, we didn't really feel like we needed to invest as much into our equipment maintenance. But after the decisions were made and every round had showed the results, we noticed that we had a significant loss at the first round, and we had to adjust our strategy to kind of play catch up for the next 3 rounds. We were only able to stabilize at round 3 to 5, but unfortunately, I think compared to the competition, we took a bit too long to kind of catch up with the competition.
Here is our performance for the competition. At the first and second round, we encounter loss for about 72, 194, and the round 2 it's 84.82, and we managed to maintain our equity between 9 and 10. And our revenue sales, we maintain to make it catching up, like increasing round per round. And our market share, we also maintain it around 9 until 10. And our product image, we managed to maintain it from 1.25 until 2. And we also managed to maintain our product quality between 0.16 until 0.98. And in conclusion, we may encounter loss at the first 2 rounds, but we managed to catch up. However, our performance is still lacking compared to the other teams due to mistake in forecasting that causes us to overspend on unnecessary expenses. Therefore, not all of our goals are met. Thank you for listening to our presentation.
Thank you. But specifically, you said you have overestimated certain things, but you did not specifically describe what are those parameters that you overestimated. Can you elaborate?
Excuse me, sir, to confirm, your question was our parameters for our goals, yes?
You have made overestimation, and then certain error in calculation resulting in your decisions not producing the result, right? So what are those specific elements or parameters that you committed error? I want to hear from you.
Yeah, thank you, sir. So the parameters that we looked at are obviously our own competitors, see where they decided to put their price and how much they invested in their expenses. In the initial round, we made a wild guess, a start of the strategy that we did in the preliminary round, and we found out it did not result as we wanted. Therefore, we spent the next few rounds making adjustments as well as judging it based off the expenses and decision of other teams. Now, as for our how we ended up with our decisions, half of it is completely from predicting the team habits, as looking at their preliminary results previously and their strategies, and then with that in mind, we adjusted our own strategies and decisions.
And I observed one on one of your slides, you can go back to your slides. I think you can put it up. Share that. Round 5. Yeah, up one more. Up one more. So right down. Okay, all right, this one. Round 5. Finish good inventory. 0. Can you tell me how you end up with a 0 finished good inventory?
Okay, thank you for the question, sir. So the reason, so the finished goods, the reason why it's 0 is because we decided to lower our production request initially because we had some inventory. We had some inventory left, but then even though yes, the inventory finished goods is 0, unfortunately the sales volume wasn't actually fulfilling the potential demand. I believe there was still a 2,000 deficit compared to the potential demand. That's why that's why it's 0.
All right. So your production should be correlated to the potential demand. So you have some knowledge of the potential demand, not exactly the same round, but the one that is before. So why are you not making the right prediction? You should ask for the production because the potential demand is there to indicate. So why is it below potential?
Okay, thank you for the question, sir. So our predictions were that we would have potential demands somewhere around the 600,000 to 650,000 mark. So we decided to have a production volume of the 540. This is because we're both using our but the quality and the image of our product as comparison, as well as our pricing, and compare it to our competitors, see how much sales they had, and then I guess put those in a ranking, and from that our team decided that it might hit around this much for their potential demand. And our prediction was somewhat close. As I said before, the potential demand that we had for round 5, I believe, was about 2,000 in deficit. So we were relatively close. And since we weren't expecting any bonus rounds, we decided to just finish the goods that we still had at this round.
Thank you. Other judges, any questions?
Sorry, like for the raw material inventory, if I'm not mistaken, like I think the volume is quite huge, like for several rounds in the beginning. So why do you decide? Oh, it's always huge, yeah, for the inventory raw material. So why do you decide like to have quite huge volume of the inventory raw material? And what is your considerations? What are the things that you consider when deciding that?
Okay, thank you, ma'am, for the question. So our first initial strategy was that we wanted to play the long game because we expected the rounds to go for a lot longer. And to do that, we decided to have enough materials in stock so that we could finish up, so we didn't have to buy the materials when the seasons are high and it's expensive. If you notice here at round 2, which is summer, we decided to buy less because we know that the material pricing is going to be very, very expensive. However, because I believe due to over expenses in other areas, we had to readjust our purchasing strategy later on. We had to keep buying more and more. As for at the round 5, we still bought a lot, even because we did take the bonus round into consideration. But for our finished goods, we decided to finish that at around 5 because we actually adjusted the production request at round 5, assuming that there isn't any bonus round, but we bought materials assuming that there are bonus rounds.
Okay, thank you.
Okay, the time is up. Thank you for the presentations. The Q&A from the judges is done. So you may go back.
Okay, so we start. Okay. So sacrifice for the greater good. We are from Bonwich, and today we're going to discuss about our analysis as well as the evaluation regarding the macro business simulation e-case competition. So Bonwich consists of 4 members. The first one is myself, Faiz, and 3 of my friends, Chufi, Faiza, as well as Michael. Please next. So the first one, we're going to talk about the management objectives. So these are all the aspects as well throughout the all around for the objective. We're going to straightforward to the discussion. So for the first one, okay. So for the first one, we focus. For the first one, we focus on the heavy investment phase. So with the net profit itself, we suffered a severe loss, which is negative 812,000. Since we focus on the increasing market share as well as R&D as a foundation, as well as the base fundamental for the further runs, such as high marketing, which is 595K, R&D 482, as well as the equipment investment. So since the net profit itself have a high negative, also on the second one, we focus to rebound as well as to gain control of the costs, which is minimizing the product allocation to solve all the inventories. The previous inventory itself is 330, and the inventory for the round 2 is only 92,000. We also reduce all the expense in all aspects for the cost efficiency. Next. For the round 3, we focus on to the maintaining growth as well as enhancing the product quality. So for the production, we focus on 475, aligned with the sales 548, while keeping the inventory low, only 19,000 by the end of the round 3. We also increase the R&D to 540K for product quality as well as maintain capacity for the equipment investment. For the fourth one, we maximize our demand. Since we know throughout these rounds, all of demand for everyone is increasing. Therefore, since we know this, for the fourth one and the further run, we focus to enhance the demand. With a net profit 233, while the sales volume grows 605 with high production and stable inventory level, increasing the R&D to 600K as well as equipment investment 300K, which is capacity scaling for sustained growth. And last round, we maximize our profit and demand, also quality, with the highest sales volume 681, with the production is 638,000, and we have 0 finished good inventory, which indicates that we have efficient production sales mapping. We also control our expense while sustaining high R&D investment, which is 300K, as well as enhancing the capacity toward equipment upgrade, which is 300K. Moving on.
And next, we will talk about management decision, and this table is show our decision from round 1 until round 5. Next. From round 1, we using a strategy aggressive market entry with the objective capture market share quickly while building a long-term production capabilities. For the second round, we using reinforcement and inventory utilization with our objective is conserve cash, reduce excess inventory, and work towards break-even position. For the third round, we using a strategy called balance recovery and quality focus. Our objective in third round is improve operational performance while strengthening a product differentiation. Next. For the round 4, we using expansion and innovation push with objective is scale production capabilities when innovating to strengthen the competitive advantage. The strategy focus in this round was on expanding production capacity, while simulating pushing innovation to secure a stronger market position. And for the last round, we using profit maximization and shareholder return. The objective is harvest profits while ensuring long-term market leadership. The strategy aims to capitalize on peak demand and profitability, while maintaining a strong innovation, which is R&D and marketing, to sustain market leadership alongside a rewarding shareholder with substantial dividends. Next.
Now let's look at the result of our strategy on this table of performance. Please notice the main trends. From a negative net profit in round 1, we successfully turned it around into a profit that grew consistently to over 360 by round 5. Revenue sales also more than doubled during this period, and our market share grew consistently. Most importantly, our product image and product quality saw dramatic jump, which became the foundation for all of this success. Next. On this slide, we will break down the evaluation behind those numbers. Round 1 was tough. We experienced a significant loss. However, our evaluation is clear. This was a high-risk, strategically vital investment. We did this intentionally to address our core problem, and the market immediately validated it. Moving to round 2, we made a rebound. Profitability was restored, which not only validated our strategy, but also demonstrated our operational excellence. In round 3, we took a mature step. Although market share dipped slightly, our profit soared. This was a conscious value over volume strategy, focusing on building a premium brand. Next. Continuing our evaluation, in round 4, we demonstrated a strategic flexibility. We successfully grew both market share and profit simultaneously, a proof of our deep market understanding. Finally, round 5 was our phase of market dominance. All key metrics reached their highest point. This was the final validation of our strategy, where we showed great discipline and the vision to become a market leader. Next.
Next, for the conclusion, over 6 rounds of the business simulation, our company successfully transitioned from an aggressive, loss-making market entry to sustained profitability and market leadership. In the early stage, we focused heavily on marketing, R&D, and capacity building, accepting initial losses to establish a strong market presence. By the mid-game, the strategy shifted to cost control, inventory optimization, and balanced investment, restoring profitability and strengthening product differentiation. During the growth phase, we maximize sales through peak R&D, stable marketing, and capacity expansion, achieving zero inventory and operational efficiency. The final round showcased effective pricing, sustained innovation, and record-breaking financial results. Overall, our phase approach to market penetrations, to stabilization, to balance growth, to profit maximization, and to prove the effectiveness of combining long-term innovation with disciplined resource allocation. That's all from us. Thank you so much.
Thank you. Can you go back to that slide that shows the performance of your company for the 5 rounds? Yeah. Okay. No. This one. Yes. I think this will give me a good to know the performance, the table. Yes. So, okay, then I think this is a very well managed company. Although you had some initial losses, but overall, actually, each round you are getting profit, and it's increasing, and your owner's equity, though it's below the beginning, but you manage at a high level. I like to see that the decisions that you make at the other slide, the table with all the decisions. Yes. All right. So you have investment in the equipment at the beginning. You have 488,000, and then you quickly reduce, and then you gradually go back up. So what was the thought? What was the thought in your mind when you round one, and then you pump in so much for the investment on the equipment?
Thank you for the question. So the reason why we focus a lot on the first round on the equipment investment, because we, as I mentioned on the objective above, for the first one we focus on the high investment. Now, after this first round, we have severe loss. We have no more cash, right? And therefore we minimize our spending towards the equipment investment, since equipment investment leads to the production capacity, whereas the capacity itself doesn't actually meet the the demand itself doesn't actually meet the production capacity. Therefore, we just want to throw aside regarding the production capacity, since the demand itself doesn't actually meet the production capacity. Therefore, on the further round, we just lower the investment towards the equipment.
I hear. Can you move back to the decision again? Yes. Now, production allocation. There is a dip in your allocation in round two. It's very, very much lower than the volume that you allocated in round one. So why was that so?
If you remember, for the first round itself, the sales volume for the first round itself actually only 300 something, whereas our product allocation itself, we can see it is actually 688. Therefore, we have excess inventory, which is around 300 something. Therefore, for the round two, in order to solve all the inventories itself, we only allocate for the production is quite low, focusing on the total inventory itself only about 500 in order to solve all the previous round inventories. That is why on the round two, we focus on holding all the inventory.
Thank you. Other judges?
Okay, I have a short question. I think you have done a very good job for the number of the rounds of the game. The only thing I want to hear from you is that because in the first one you adopt a very aggressive strategy, right? From buying 500,000 investment, right? Paying 500,000 investment on your equipment. As a result, is introduced 1 point something million, right, of your overdraft in round one, right? Would this be the reason why your scoring in the time interest earned is not as high as the other team, you think? Because you have an interest, right? That will carry over from round to one, because in round two you have no way to pay back the debt to the bank. But would this be a short?
Actually,
sorry.
Oh, okay. Yes. So actually, because of our aggressiveness in round one, which leads us to severe loss, as well as we have several interests into abnormal liabilities, which then will be counted as debt for the further rounds, which is exactly the reason why our time interest rate is the score is relatively low.
Yeah. Does it mean that you did not put this? Can you hear me? Okay.
Yes, I can hear.
Sorry. I just say, so does it mean that you haven't put this in mind before your decision make? Because if you puts a big investment on this equipment, right? Procurement, that might probably you are running out of cash to carry over your other business. So then you may have adapt in the debt issue and then introduce the interest problem. So have you put this in mind before the decision of the round one? I just want to hear from you. Yeah. You can't hear from me?
Yes, I can hear, but can you repeat the half of the question? Yeah.
Have you consider, right, this issue before you taking the decision in round one?
Okay, we already take this consideration because we also look at the scoring as well as the percentage as well. However, the thing is we have the miscalculation as well as misprediction towards the demand itself, which is why we can see the round one, the product allocation, we positive and have optimistic with least to the sales volume around 600,000. But however, the actual sales volume after the round ends is only 300, which leads to the negative net profit, which leads us to have a debt. So technically, we already considered, but due to the miscalculation towards the demand itself.
Okay, thank you very much.
Thank you, sir.
Okay, thank you, Ribbon Rich, for the presentations. Now you may go back to the main room.